Good morning, and thank you for joining Pristine Advisers in our series of webinars. Our webinar today is entitled Finding Alpha Through an Active Strategy. We have included a copy of the presentation under the handout section of your screen if you would like to follow along. Joining us to present this webinar is Ted Theodore. Ted is the Chief Investment Officer at Trim Tabs Asset Management. He specializes in both portfolio management and investment strategy. So here to start things off for us this morning, welcome Ted.
Thank you very much. If we could go right to the slide material and pass the first page, which talks about finding alpha through an active buyback strategy, and go to slide 2. Just a little bit about Trim Tabs Asset Management. This is a spinoff, really, of an institutional research provider that was founded in 1990 by Charles Biederman, noted investment researcher, who did original research on mutual fund flows, and then that research expanded into keeping track of offerings, keeping track of buybacks, other corporate information. And about 5 years ago, Trim Tabs Asset Management was spun out of that research effort, which still continues. But now we have a separate asset management firm that focuses on free cash flow and share count as drivers for finding that sustainable investment alpha. And over the last year, we've added major resources to augment the firm, and we now have one of the most experienced investment management teams in the industry, backed by very strong ownership and resources. So that's a little bit about Trim Tabs Asset Management. If we go to page 3, you'll see some of the principals, including Charles and Alan Rubenfeld, who is also on the call, who is our Director of Sales and has extensive background in both the buy side and the sell side, particularly in the exchange-traded product. And in my background, basically in money management and strategy space, in almost all in New York, all of it in New York. Let's go to page 4 and talk a little bit about buybacks. They're in the news, obviously, and we wanted to draw your attention to a Deutsche Bank study that was referred to in an article in Barron's 3 or 4 weeks ago. And what they found was that the mere announcement of a buyback does carry with it an extra return. And you can see that on the chart on the left-hand side, showing that going out as far as 60 days, there's still an impact from that announcement. And if you just use the strategy of following the announcements according to the Deutsche Bank research, it can be quite a good strategy that's shown on the right-hand side. But we want to provide some context to that notion that just following buyback announcements give you good return. That certainly has been the case in the past. But we think there's important distinctions in this process that that can add value and also alert you to the general idea of buybacks. So we think that buybacks are not all created equal, and the way to see that is to start with corporate information on page 5. And here, the most important challenge really is dealing with the fact that corporate management, corporate financial reporting involves a tremendous degree of discretion in how they report revenues, how they report costs, assets and liabilities, and particularly most folks don't think about assets and liabilities that much, but as the economy moves more towards a service environment, those assets tend to be intangible assets, and there's a great deal of discretion in how to report intangible assets. This problem of the challenge of corporate financial reporting was reinforced by in an article in the January-February issue of the Financial Analyst Journal, and that article was entitled "The Misrepresentation of Earnings." And just a quote from the article, which was a summation of a survey of 400 CFOs, basically their conclusion was, the CFO's conclusion was that 1 in 5 reports is misrepresenting earnings because of the discretion that's allowed within generally accepted accounting principles, GAAP earnings, and that the magnitude of these misrepresentations are quite material in the sense that they could be 10 cents on every dollar. And as you know, we're right in the middle of earnings season, and we're obsessing about every penny. So it's something to be alerted to, and what the CFOs recommended was that while they may not be misrepresenting their earnings, they are cautious about looking at other earnings reports, and they found that the best way to protect themselves is to watch how cash flow differs from what corporations are reporting from operations and or GAAP earnings. And so if there's not a correlation with cash flow, then that's an alert. So knowing that, if you go to page 6, slide 6, what are the benchmarks of a strong company? Well, particularly for us, it's cash. We think that at the end of the day, if you don't have cash in the bank, you can maybe get away with a few quarters of misrepresentation, but it'll catch up to you if you don't have organic growth and or the cash that is generated by that organic growth. So that's why we focus on cash flow. We think it's more transparent for shareholders, and although it's not foolproof, it does reduce and minimize the amount of accounting gimmickry that is going on. And then the second thing that we think about as a strong company is that it has a superior balance sheet, and we'll get into why we think that's important, but on its own, it clearly makes sense that not only should the company be growing, but the balance sheet ought to be improving as the company grows. And then finally, because we're selfish and we own the shares of these companies, we would like to have a bigger piece of that pie, and the way that happens is that the share count starts to shrink. So those are the 3 elements of what we think constitute a strong company, a reliable company, one that's you can depend on going into the future. So on the next slide, slide 7, our actual process starts with the 3,000 stocks in the Russell universe, which is about 98% of the investable U.S. stock market. And then using our own proprietary algorithms, and by the way, this process is an active process. It's not a passive process where we're just creating an index and then rebalancing to that index. No, we actually have a active management of this process using our own algorithms. And what they do is they look at 3 things. They look at the growth in free cash flow. They look at what is happening to shares outstanding and what is happening to the balance sheet. And just for a second, going back to the shares outstanding, and this is one of the reasons why we say that all buybacks are not created equal, it's that buyback announcements aren't always correlated with actual share count. Companies announce buybacks, but they don't always fulfill them. They can also announce them, but offset them by offering shares, particularly to management. So rather than getting dependent on just the announcements, we go to the actual share count. And that takes into account whether or not the announcement was followed through and whether or not there are additional shares being offered. So the rubber hits the road at the share count rather than on the announcements. So we have all those 3 factors that we use a very disciplined quantitative algorithm for, and create a composite score from those 3 factors, and that composite score ends up ranking all the stocks that we are looking at. We start with 3,000 stocks, and because we want stocks, the underlying stocks, to have a fair amount of liquidity, we do also add a trading liquidity requirement, and that cuts the universe down to about 1,500 stocks. And from there, we compare on slide 8, we just look at the score for each stock, the 1,500 stocks, and then rank them in the universe. And then the process of the management, the active management, just is simply looking at the lowest scoring stocks in the portfolio in the application that would be candidates for removal, and then just concentrating on the highest scoring stocks that are candidates for inclusion. Fairly straightforward, but the active part of it allows us to do this further monitoring that's highlighted here on the left side, where we can monitor sector weights and very importantly, tax consequences. So we have the discretion and the ability to do that. Finally, because when you have 1,500 stocks and three factors that you're using and a composite score, the composite scores might, for 5 or 6, 10 stocks might be the same, but the way we get there is different based on the 3 factors. So you might have 2 very good scoring factors and 1 not so good, creating a composite score that equals another company where they're kind of all at that same score. So we have the ability to break those ties through our discretionary. Still using the same 3 factors, but instead of using something like just the alphabetical listing of the securities, we can actually look at how that score is generated and take advantage of that. We have 100 stocks that we emphasize, starting with equal weighting in those positions when we implement changes in the portfolio, and that portfolio results in the kind of style map that's shown on the right hand of slide 8, which came from Morningstar, where we are somewhere between large and medium in terms of their correlation of where we are with the cohorts, and we're somewhere between core and core growth. And essentially what that means is that we are placed in the mid-cap blend category. And if you go to slide 9, one of the things we think of is that this process is an alternative to mid-cap mutual funds, and that might not seem obvious, but here's why. When you equal weight the securities in the portfolio, and if you have 100 of them, you're going to tend to correlate more with the mid-cap indices than with, say, the S&P 500 or the S&P 100, which are cap-weighted and are influenced by a handful of securities. In the case where you equal weight and have 100 stocks, the correlation is closer to mid-cap. And so this approach is an alternative to the mid-cap space, and that's where Morningstar places our strategy. We also think that this is a core holding in the sense that we're looking at strong companies that have had a good track record of organic growth, improved balance sheets, and pretty importantly, a reduced share count, so that if you are a shareholder, you're getting a bigger piece of the pie. But we think it's an all-weather fund in the sense that if rates, for example, if the Fed goes ahead and continues to normalize rates, that might raise issues with a number of companies that have been doing buybacks, but they've been doing the buybacks by using debt. And so that's one of the reasons, another reasons why we think there is a difference between an active strategy that has these other factors and just plain buyback strategy. So if rates go up, there's probably going to be an impact on the number of companies that can offer the attraction of a share reduction. If there is a recession and the economy rolls over, at least we have the initial cushion of companies that have good balance sheets, that share count reduction and growth in free cash flow. So we kind of think of it as an all-weather. Even though we correlate with mid-cap blend, we have a smattering of very large companies in the portfolio as well. So it is an allocation to multi-cap as well as the mid-cap. On the active side of the strategy, which does produce alpha, we're basically watching this process every day. We're on the wall guarding. We're watching how things develop. Now, obviously, some of this data doesn't change except monthly or quarterly. On the other hand, we do get data changes in share count, and we can also watch how the drift is going in the change in free cash flow and the change of balance sheet. So as an active manager, we can be responsive to changes more quickly than if it was just a passive process. In terms of another part of the all-weather idea is, and this is probably not something that most people think is possible, certainly consensus is not looking at that, but somehow, let's say we hypothesize that the clouds, the macro clouds start to part and a better market environment ensues and people want to take on risk. Well, these are organic companies and they tend to include mid and smaller cap opportunities which typically get rewarded in a risk-on market. And then finally, just want to reiterate that just using a passive buyback strategy like that represented in the NASDAQ Buyback Achievers Index, which is reconstituted annually, does miss a number of these other factors that are at work and distinguishes between companies that are using debt to buy back and those that are using free cash flow to do their buybacks. So we do think it's an alternative to just a passive approach, and it's important to have that active process at work. Let me stop it there. You can send questions in. A number have already been sent in, and then later you can contact Alan Rubenfeld. His contact information is there, or me. I'm at ted.theodore@trimtabsfunds.com, and we'd be happy to answer those questions. So if the moderator can start with the questions, we'll be happy to try to give some answers to them.
Yes, thank you, Ted. We do have a few questions from the audience, so we'll begin with, do you recommend picking stocks with the belief that you can allocate capital gain rather than simply buying a passive fund and holding it forever?
Well, I think my opinion would be obviously that active management is very important for the reasons that I mentioned, which is that changes are taking place in corporate results constantly. The economic cycle is at work. We're either in expansion or contraction, and the ability to be able to respond to that very quickly through an active management where we can manage turnover, where we can manage the differences between closely scoring companies, where we can manage sector allocation, where we can manage tax implications, really makes the case for active versus passive.
Great. Next is, what is a typical return on buybacks?
Well, I mean, that's a two-part question. One is our returns have been better than the passive returns, and you can explore that at our website. But the returns just to the strategy of buyback announcements is shown on that slide that Deutsche Bank did. Everybody kind of and that'll change depending on the period that you're looking at. It's very base dependent.
Yes.
Yes. Very base dependent on what period you're looking at, but it's generally thought to be in around the 2 to 5% per annum kind of addition to returns.
Okay. Next we have, why have there been historically so many takeover names in the portfolio?
Well, we have been fortunate in that regard, and it's not by design. It's a result. It's a result of having a focus on organically growing companies that have good balance sheets and have treated their investors well through reduced share count. So these are companies that fall into a category of strategic acquisitions. As you know, in last well, since the start of the bull market in '09, there have been a fair amount of M&A activity, but a good portion of that M&A activity has been what you would call financial engineering, so acquisitions merely to reduce costs but not to change the strategy or augment the strategy of the acquirer. In our case, typically the companies that have been acquired in the portfolios have been companies that have had organic growth, and so they tend to fit into an M&A activity that's looking for strategic application. I mean, there's both kinds of M&A, the financial engineering, and then there's organic. To the extent that the environment is, particularly if the macro environment stays reasonably positive or even better, then probably there'll be more targeting of this kind of company. So we didn't design it that way, but it's not a surprise because corporate strategists and investment bankers are looking for these kinds of companies when the assignment has to do with strategy rather than just financial engineering.
Okay. Now, what is the prospect for cash M&A spending by S&P 500 firms?
Well, I'll just quote what S&P is guessing, and obviously this is totally dependent on the cycle, economic cycle, but they're guessing around a 5% improvement, and that's about what it's been over the last 18 to 24 months. Early in the economic expansion, it was lower than that. Then it rose to about that rate, and it's been steady at that rate, annualized rate, for last, as I say, 18 to 24 months. And so they're just trend lining that. I certainly don't have the ability. I don't think anybody has the ability to predict anything. They're just kind of guessing what the immediate future might look like, which is probably close.
Okay. Now, are the sectors that the portfolio history been over or underweighted?
Okay, we don't have a particular sector bias beforehand, but as it turns out, the one sector where we typically are not exposed or have very little exposure is utilities, electric utilities, and to some extent natural gas distribution utilities. The reason for that is that there's a lot of debt on the balance sheet of utilities. They typically are not that interested in improving the quality of the balance sheet because they get to apply for rate relief based on their capitalization, and so they don't really have a great incentive to reduce share count, or for that matter, have a debt-free balance sheet. And of course, when you're putting in the kind of equipment that they have to put in for electric generation, it is capital intensive. So we tend not to have exposure to the utility sector, but other than that, there's really no bias in the sector allocation. Right now, we're a little bit overweight in tech, a little bit underweight in healthcare. I'd mentioned that even though the biotech group has had a very strong performance, say from maybe 2.5 years ago to about 6 months ago, the free cash flow growth there really isn't as strong as it had been. I'm not an expert on biotechs, but that has been reflected in the selection process here, the scoring process, and so biotech has actually been reduced in weight over the time. And there's been some takeovers there, which we certainly like, but it's a little bit anomalous to think of biotech as you think of it as a growth area, it's really struggling a little bit on the free cash flow side. So that would be another sector that I'd mention. But again, there's no biases in the work. We just follow the data.
Okay. Next, are share buybacks a sell signal?
Well, I don't think so. Share buybacks are cyclical themselves, which kind of surprises people. In other words, last summer, last June, July, when people were starting to get worried about the market, some folks said, well, we can't have any trouble because there's so many buybacks. But what really did happen in the third and fourth quarters last year was that the pace of buybacks also contracted. Now that would seem counterintuitive in the sense that if the management knows what's going on and their share is going down, you would think they would increase their share buying, but in fact it is cyclical. Share buybacks receded. They didn't go down as much as the market did, but it actually didn't go up during that period. And the reason for that is kind of just psychological. When a CFO or treasurer who's responsible for the buyback enactment goes ahead and places the order with their favorite broker, the broker will call and say, hey, your stock is down, why don't we wait a few days before we buy it? And so that's just a human response, and that's what happened last summer. But I don't know of anyone who thinks that the level of buybacks is a forecast of returns. It's more a reflection of returns. We saw that in the early part of the bull market in 2009, 2010, when the market was booming and buybacks were increasing their pace. So it's more cyclical than most folks think, but I don't think it's any more than the market rising or falling itself is a prediction of the market rising or falling.
Okay. The trim tab strategy has generally outperformed all major benchmarks for the past 4.5 years. Are there market conditions where it could possibly underperform?
Well, sure, certainly that's likely to happen in a couple of circumstances. One is the one that I wouldn't be surprised about would be if we do have a bear market. Typically in the first phase off of the bear market rebound, the companies that have done the worst are the best performers in the first 6 or 9 months. That was certainly true from March of 2009 for the rest of the year. Everything that had gotten torn apart in the crash in 2008 and early 2009, they were the leaders in the market. So we're not going to do well in that kind of a market. But I think otherwise we do have organically growing companies with high quality in terms of their balance sheet. So I do think that under most circumstances, whether it's a bull market or a recession, we'll do okay. It's just in those snapback markets that I think everybody has a difficult time with those kinds of strategies, any kind of fundamental strategy, because in a snapback, fundamentals aren't really rewarded. But we're tied to fundamentals, so eventually they will out.
Okay. And how much do buybacks contribute to the overall demand for shares?
Well, again, I think that's open to discussion and argument. We think the companies that are reducing their share counts are more important than ones that are just merely announcing share counts. There's speculation. I don't think the research is all that compelling that, again, something around a 5% increment to what would have happened might be traceable to the buyback phenomenon. But really, I'm not here to push for a period of buybacks or not. What we're looking for are to go a couple levels deeper than that and actually look at the companies, and not so much as it's just a buyback. That's great, but we don't want to be exposed too much to companies that are taking risk by adding to their debt or not having cash in the bank to help finance this kind of thing. So we like to get deeper into the strategy. It's fine to have the umbrella of the strategy. That's great. It has some positive impact, I'm sure, but we think it pays to be digging deeper and to be active on this.
Okay. And what are the advantages to active portfolio management as to following an index-based strategy?
Well, I don't think there's index strategy is perfectly fine if what you want is the beta of that index. That's what you'll get, and you won't have interference from folks trying to who may or may not be able to generate alpha, changing that return. I think that's perfectly acceptable. I think on the active side, what's important, at least from my perspective, and my history is that I think I was one of the first ETF strategists starting in 1998 and using a whole group of ETFs to fulfill investment strategy. What I was looking for was I was looking for sustainability, I was looking for repeatability, and I didn't want any surprises. And so that's the characteristic of our investment process, which is that there's not wholesale change. It's a gradual reflection of how the fundamentals are changing. We don't want to provide surprises to our shareholders and to our investors, so we're pretty open about what it is that we do, and we'll try to provide a comfortable degree for the investors that they won't wake up some morning and see an entirely different portfolio. That is not going to happen with what we do. So there are degrees of active. We're closer to the passive side, if you will, by having researched quantitative algorithm that is repeatable. Then, you know, if I just woke up someday and said, gee, I don't feel good, I think I'll sell stocks. Any other questions?
I'm not seeing any questions. Increase the debt-to-equity ratio for an under-averaged firm. And how can this increase shareholder value? I'm sorry, an under-leveraged firm.
Okay, so let me try to unpack that a little bit. It's not entirely clear. Maybe I'm not getting the question the way the questioner intended, but you can't sustain the company by only using debt to give the appearance, because that's all it is, that the company's doing well. Share earnings would increase if share count went down. That's earnings per share would go up if share count went down. But if that happens because debt is being taken on, and the debt-to-equity ratio is deteriorating, more debt than equity, then I can't see how that's a sustainable approach for any company. That doesn't mean over the short run the company won't be celebrated in the market. This market has paid for financial engineering, but we think the sustainable companies are the ones that are doing it with growth and free cash flow, and that includes improvement in the balance sheet.
Okay.
Ted, I have one more question here. It's really a combination. We got a question asking if companies are better off reinvesting their profits back into the business or acquiring other businesses as opposed to buying back stock.
Well, it's really a question of make or buy, and when the corporation has thought through its strategies and realizes it can buy a strategy, it is going to go after the kinds of companies we think that we invest in. Not every company thinks in those terms. They will go out and make their own investment to try to expand the strategies of the firm, but clearly they make the calculation, make or buy calculation, and in many cases they, even with a premium that results, and typically our experience has been that there's something like a 30-35% premium pretty closely following the announcement of a takeover, that even with that calculation, it makes sense for them to buy rather than build. So it really depends on each individual corporation. But we've had enough of those experiences that's added to the performance of the portfolio.
Okay. We have what investment strategies will generate outperformance in a flat market environment?
Well, depends on what the flat market environment is why it's happening as a flat market environment. If there's no growth at all anywhere, then it is hard to distinguish yourself as a fast-growing, organically growing company. I'm assuming that the flat market characterization really is kind of a timeout or a consolidation, and either going towards a resumption of a bull market or the start of a bear market. And so that means that the underlying factors still are changing, and we want to be with those higher quality companies that are the kinds that we're focusing on with the three factors.
Okay. And we have one last question, which seems personal, by Dave Morton. He said, how will being a Michigan football fan help your success now that Harbaugh is...
Dave is a great guy. Well, we expect to earn the national championship this year.
I would just add, I hope the correlation between Michigan's performance and our performance this upcoming year will closely monitor one another.
Now, Alan is also a Michigan grad, so you've got some bias here.
Okay, so that seems to be all the questions we have for this webinar. So I would like to thank Ted for a very informative session, and thank you all for joining us. And just a reminder, this event does qualify for 1 CFP credit. So if you're interested in receiving credits and have not provided me with
Seems we lost Teresa, but if you have not provided us with your CFP number, please email it to tbarrows@pristineadvisers.com, and we'll be sure to include that so that you receive your CFP credit. This event will be replayed again. Give it about an hour for the recording to be uploaded, and then we will have this as a replay for you. And any other questions that you have for our wonderful presenter, Ted Theodore of Trim Tabs Asset Management, feel free to email Trim Tabs or ourselves. The email is also on the presentation, alan.rubenfeld@trimtabsfunds.com, or you can reach us at Pristine Advisers at pristineadvisers.com. And we thank everyone again for your participation and your interest, and we look forward to seeing you at our future webinars. Thank you so much.